If you're watching this, chances are you're like a lot of folks across the Pacific Northwest, from Portland to Seattle, down into Boise, or even Spokane. You're probably glued to the news asking that one big question: when are mortgage rates finally going to drop? Or are they going to keep climbing? It's the question on everyone's mind, and frankly, it's a huge factor in whether you're buying your first home, looking to move, or even thinking about refinancing. Hey everyone, and welcome back to my channel. I'm Matt Jolivet, an independent mortgage broker and president of Associated Mortgage Brokers. And today we're diving deep to answer that question. We'll start by looking at what really moves mortgage rates on a national level, then break down the latest expert forecast for the rest of 2025 and into 2026. I'll even show you some technical analysis directly from my charts to see what the trends and key levels are telling us. Finally, we'll bring it all home to discuss what these predictions mean specifically for the Pacific Northwest housing market, and most importantly, actionable strategies you can use right now to navigate these rates. So let's get into it. Section 2, the big picture: what influences mortgage rates? Before we get into the nitty-gritty of the forecast, let's quickly break down what actually moves these rates. It's just not the Fed, although they play a massive role. First, you've got the Federal Reserve. While they don't directly set mortgage rates, their actions on federal funds rates definitely influence the overall cost of borrowing and influence the bond market. Right now, the general consensus is that the Fed will likely hold off on significant rate cuts until later in 2025, maybe even stretching into 2026. Why the delay? Well, inflation is still being a bit stubborn, and we're still ironing out the tariffs, and our job market has been surprisingly strong. They want to see consistent signs that inflation is truly headed back to their 2% target before making big moves. Then there's inflation itself. This is a huge driver. If inflation cools down consistently, it gives the Fed room to cut rates. If it flares back up, rates tend to follow. And finally, watch the 10-year Treasury yield. This is your primary benchmark. Mortgage rates usually dance to the tune of what the 10-year Treasury is doing. All this economic data, jobs, reports, GDP growth, consumer spending, it all feeds into these yields. Section 3, National Expert Forecasts for 2025 and 2026. So, with that in mind, what are the big players saying for 2025? As of the last week of May, Fannie Mae has lowered their rate forecast again, which is positive news. Their latest prediction now has 30-year fixed mortgage rates ending 2025 at 6.1%, down from their previous forecast of 6.2% and falling to 5.8% by the end of 2026, down from 6%. Other major institutions, like the Mortgage Bankers Association, might have a slightly higher forecast, sometimes around the high 6% or even touching 7%, which we are touching at the time of this video. Now, that 5.8% for late 2026 is particularly significant. Fannie Mae estimates that if we hit that range, around 4 million mortgage loans would become eligible for refinance. To give you some context, there were only approximately 1.3 million refinance loans done in all of 2024. This forecast suggests a potentially massive wave of refinance opportunities on the horizon if those rates materialize. The key takeaway here is this: don't expect a sudden dramatic drop back to those super low 3% or 4% rates we saw a few years ago. That's likely a thing of the past for now. We're more likely to see a modest, gradual decline, settling into the new normal range, possibly between 5.5% and 6.5% over the longer term. Think of it as a slow, steady ship, not a speedboat. Section 4, Technical Analysis of Mortgage Rates, the charts. Now, for those of you who like to dig a little deeper, let's talk about the technical side of what the charts are telling us. As a mortgage broker, I'm personally watching these charts every single day, looking for clues about where rates might be headed. First, let's look at the 10-year Treasury. Remember, this is our main guide for fixed mortgage rates. As you can see here, we've been stuck in this sideways range for about 2 years, testing support and resistance, breaking both barriers a few times just to return back in the red box of sideways action. Now, let's identify some of those key levels. We can clearly see a resistance level right around 4.7%. Every time we break this key level, we drop back down. This is like a ceiling where yields have struggled to break above and hold. And below that, we have a support level forming around 3.95%. This is like a floor where buyers tend to step in and prevent yields from falling further. If yields break convincingly above that resistance, we could see mortgage rates follow higher. If they break below that support, that opens the door for rates to come down. Now let's look at the actual 30-year fixed mortgage rate chart. This is what most of you are interested in directly. As you can see, it often mirrors the movements of the 10-year Treasury, but it has its own unique levels. We can also identify resistance and support on this chart. The 7.07% mark has been a healthy line of resistance. Each time we touch this mark or break over, rates head back down. And they found a floor or support around 6.59%. We seem to bounce off this mark every time we touch it. I've also identified a second layer of support. If we break below the 6.59% mark, 6% is the next layer of support, which aligns with the experts' predictions. These are crucial battlegrounds. As you can also see, I have identified the current trend of lower highs, which is what we want to see when we are hoping for lower interest rates. Clearly, not a straight path or quick path down, but a trend in the right direction. A sustained breakout of these ranges, whether up or down, would signal a more definite shift in the market. What I'm watching for are clear breakouts or breakdowns from these established ranges. This choppiness on the charts means rates can be a bit volatile day to day, but the larger trend is still being dictated by those fundamental economic factors. Section 5, Pacific Northwest specifics and local market trends. Now let's bring it home to our backyard, the Pacific Northwest. What does this mean for Oregon, Washington, and Idaho specifically? Our region is unique, and we've seen varied market performance. While places like Boise, Idaho saw a massive boom and then a significant correction, they're now stabilizing. You're seeing more inventory there, which is good for buyers looking for options. In Oregon, particularly around the Portland metro area, we've experienced a bit more price softening and increased buyer leverage. Prices are holding steady or easing slightly, which could make it more buyer-friendly in 2025 and 2026. Washington, especially the Seattle area, continues to see strong demand and climbing prices. Although the pace has slowed from its peak, further east in places like Spokane and Tacoma, you're seeing rising inventory and more tempered price growth, potentially offering more negotiating room for buyers. Inventory remains a big factor across the Pacific Northwest. Many homeowners are locked into those lower rates from a few years ago and are hesitant to sell. However, we are seeing signs that this lock-in effect is slowly starting to wane as life happens and people need to move. And importantly, new construction is a key source of inventory. Builders in the Pacific Northwest are offering incentives like rate buydowns or closing cost credits to attract buyers, which can be a fantastic opportunity. Section 6, Strategies for Pacific Northwest homebuyers and homeowners. So what does all of this mean for you, whether you're looking to buy, sell, or refinance in the Pacific Northwest? Don't wait for the bottom. Timing the market perfectly is nearly impossible. If the current monthly payment works for your budget, securing a rate now might be a smarter move than chasing a hypothetical lower rate that might not materialize when you need it. Be cautious with ARMs, adjustable rate mortgages. While ARMs can sometimes offer a slightly lower initial rate, the current spread between fixed and adjustable rates isn't typically large enough to warrant the risk of a variable rate for most home shoppers. Unless you see a significant upfront benefit, like a 1% or greater difference, and have a very clear short-term plan, a fixed rate often provides more peace of mind in this market. Explore rate buydowns. This is huge, especially with new construction. Understanding how to use points to lower your initial interest rate can save you a lot of money up front. Focus on long-term value. The Pacific Northwest remains an incredibly desirable place to live. Buying for long-term appreciation rather than short-term gains is a prudent approach. Shop for the right fit. Rates can vary, and what's best is often specific to your unique financial situation and goals. Working with an independent mortgage broker, like myself, can provide significant advantages. A recent study by Polygon Research, which examined the most recently available HMDA data, found that consumers saved an average of $10,662 over the life of the loan when working with an independent mortgage broker as opposed to a non-bank retail lender. My role is to shop across my network of specific lenders to find the program and rate that best fits your specific needs, helping you compare different options and find the right solution for you. The Pacific Northwest mortgage market is always dynamic, but with the right information and the right strategy, you can absolutely navigate it successfully. If you're wondering how these forecasts impact your unique situation in Oregon, Washington, or Idaho, I'm here to help you understand your options. Click the link description in my bio to schedule a free, no obligation consultation with me, Matt Jolivet. Let's make your home ownership dreams a reality. If you found this video helpful, please hit that like button, leave a comment with your thoughts or questions. I love hearing from you. And of course, subscribe so you don't miss future market updates. Thanks for watching, and I'll see you on the next one.